What's up, everyone? Logan Freeman here with Midwest CRE Advisors. Today, I want to talk through something getting a lot of attention in the headlines: proposals to limit institutional investors from buying single family homes, and what that actually means, especially for markets like Kansas City. You've probably seen the recent news about efforts to ban large institutional buyers from acquiring single family homes, with the idea that it could help housing affordability by keeping homes in the hands of individual buyers. That story is getting traction in the national press because supposedly institutional buyers have been gobbling up homes and pushing prices higher. National reports have noted that institutional buyers accounted for a significant share of single family home purchases recently. Roughly 1 in 3 single family homes sold in the second quarter of 2025, according to some estimates. But the reality on the ground is a lot more textured. When you look at the full picture of the U.S. housing supply, about 87 million single family homes nationwide, institutional investors only own a very small portion of that total, on the order of about 0.6%. Most single family rental homes, about 89% of them, are owned by local, small scale landlords with 10 or fewer properties, and many of those own just 1 or 2 homes. The narrative that institutions dominate the market just doesn't hold up for the country as a whole, even though there are pockets where institutional ownership is more concentrated. Institutional buying has also been ebbing in recent years. Since interest rates started climbing in 2022, with mortgage rates moving from the low threes into the 6 to 7% range nationally. The cost of financing homes has pushed many large firms to slow purchases or even sell inventory. That has pressured their return profiles, especially as home prices remained elevated and competition with owner occupants got tighter. Now let's bring this home to Kansas City, where the market dynamics look noticeably different from those outlier metros people talk about on social media or in national headlines. First, housing prices here tell a story of moderate growth rather than runaway increases. In the Kansas City metro area, median home prices were around $280,000 in late 2025, up slightly, roughly a couple of percent, compared to the year before. The median listing price across the combined metro area has been reported in various places around $310,000 to $325,000, which reflects both the Missouri and Kansas sides. We also see that average home values in Kansas sit closer to $190,000, with modest year-over-year changes. Inventory here also tells part of the story. Housing supply in the Kansas City region remains tighter than national averages, with just over 2 months of supply on the market, which is below national levels, and keeps conditions relatively competitive. Meanwhile, rental demand here continues to be stable. Average rents for all property types in Kansas City hovered around $1,300 to $1,400 per month as of early 2026, a figure noticeably below many coastal markets, but still representing strong demand relative to local incomes. The broader trend in Mid-America has been one of steady demand with moderate price growth, where jobs, population, and cost of living all play major roles. Over the past few years, the Kansas City Metro added nearly 25,000 residents in 2024 alone, with total population growth since 2020 of more than 60,000 people. Growth of that magnitude fuels ongoing housing demand, both for ownership and rental, and points to why supply remains such a critical factor here. So when you think about potential policy moves targeting institutional buyers, it's worth asking, would that materially shift Kansas City's housing trajectory? The data suggests it probably wouldn't, at least not in a dramatic market-wide way. Institutional buyers here do exist, and in some years, they rank among the top 10 markets for institutional sales activity. But even in those cases, they don't dominate the overall housing stock, and their share of purchases has been declining. One regional newsletter from mid-2025 flagged that institutional investor purchases in the Kansas City metro were around 11% of sales, down from earlier levels, and that this represented one of the higher percentages among U.S. metros. That said, if institutional buyers continue to pull back from the existing home resale market that could open up opportunities for individual buyers, particularly first-time buyers and smaller investors looking to build local portfolios. It could reduce competition in certain price bands where cash offers and quick closes have made things tougher for owner occupants. But the bigger drivers of affordability and access here are not institutional ownership percentages, their supply, permitting, construction costs, and mortgage rates. Even with the inventory ticking up and homes sitting on the market longer in some months, builders still face high labor and materials costs that slow new housing production. And despite price moderation in parts of 2025, Kansas City's median prices still sit well above pre-pandemic levels, thanks to sustained demand and relatively limited new supply. So for investors, developers, and agents here, the real levers are still where they've always been: increasing housing supply where it makes sense, aligning product with local demand, and underwriting with realistic cost and financing assumptions. Whether an institutional buyer is in the mix or not, those fundamentals shape long-term trends far more than headlines ever will. That's the perspective worth holding on to. As we look into 2026, policies aimed at a small slice of the market can make headlines, but the underlying dynamics, population growth, supply constraints, costs, and local market characteristics, like we see in Kansas City, are what determine how prices and rents actually move. Thanks for listening. This is Logan Freeman with Midwest CRE Advisors. If you're an investor, developer, or agent operating in the Midwest, this is exactly why local data matters more than national narratives. And if you want more breakdowns like this, grounded in real numbers, not noise, make sure you're subscribed.